Welcome to The Explainer. Today, we're diving into a massive puzzle right at the heart of the stock market. Why does it so often seem to act, well, irrationally? The answer, it turns out, comes from a really groundbreaking paper that completely changed how we think about the psychology of investing. For decades, the main theory was that markets are these perfectly rational, efficient machines, that prices reflect all the available information, like instantly. But if you've ever actually watched the market, you know the reality feels a lot different, almost strange. And it's not just a feeling. Researchers have found all these consistent, really puzzling patterns. For instance, stocks that are doing well tend to keep doing well for a while. We call that momentum. But here's the weird part. Those same high-flying stocks often end up becoming long-term losers. That's a pattern called reversal. These aren't just random flukes. They happen way too often. Okay, so if the market isn't some perfect logic machine, what exactly is it? Well, the first step in solving this mystery is to look at the usual suspects, the old school explanations, and see why they just don't add up. The old arguments would say things like, oh, these patterns are just statistical noise, or maybe it's just a fair payment for some kind of hidden risk. But the evidence just doesn't support that. The patterns are too strong, too persistent. The real answer, it turns out, isn't in the spreadsheets, but inside our own heads. And this brings us to a landmark paper from 1998 that proposed a totally radical new idea. It argued that the key to understanding the market isn't found in some super complex economic model. No, it's found in two simple but incredibly powerful quirks of human psychology. And here it is, the central theme, the one idea that unlocks everything. Investors systematically overreact to their private information, their own secret research, their gut feelings, but they underreact to public news that everyone else sees, like an official earnings report. So the first pillar of this theory is a psychological bias that affects pretty much everyone, from the first-time trader all the way up to seasoned pros, and that is overconfidence. Now, this isn't just about being generally optimistic. In finance, it means something very specific. Investors think their own research is way more accurate than it really is. They'll look at public news with a healthy dose of skepticism, sure, but they put way too much faith in their own private hunches and spreadsheets. This is really the root of the bias. To an overconfident investor, the work they did, that private signal, it feels incredibly precise and valuable. Meanwhile, the public information, the stuff that everybody has, it just seems less important, not as relevant. And the result of this, it's totally predictable. Overconfidence causes investors to get carried away by their own great ideas, pushing a stock's price way above its actual value. This creates a bubble, an overreaction, that eventually has to correct itself as reality starts to sink in. And that right there, that explains long-term reversal. But hold on, that overreaction is only half the story. It explains why stocks eventually fall back to earth, but it doesn't explain momentum. It doesn't explain why they keep rising in the short term. For that, we need the second psychological pillar of this theory. This bias is all about how we explain our own successes and failures. It's a classic human trait, summed up perfectly by this phrase. When things go right, it's because of our skill. When things go wrong, well, that's just bad luck. And in the market, this plays out in a huge way. When public news comes out and confirms that an investor's private research was right on the money, their confidence just soars. They think, see, I'm a genius. But if the news proves them wrong, they just kind of shrug it off, thinking, the market's just being weird today. Their confidence barely takes a hit. So, let's put it all together. What happens when you combine an investor who is already overconfident with a bias that makes them even more confident every single time they get something right? You get a powerful feedback loop and a complete picture of why the market acts so strange. All right, look here. On the left, you see what overconfidence does all by itself. A big overreaction and then a long, slow correction back down. But now, look at the right. When we add in that self-attribution bias, the whole game changes. Instead of correcting when good news comes out, those overconfident investors double down. They become even more sure they were right all along, and they push the price even higher. And that period where the correction is delayed, where investors just keep piling on because confirming news has supercharged their confidence, that is momentum. It's the winner keeps on winning effect, and it's born directly from this psychological feedback loop. And the simulations of this are just beautiful. They confirm it perfectly. With this attribution bias, the price path follows this very distinct hump shape. You see an initial overreaction, which is then followed by a period of continuing overreaction. That's your momentum. And then, finally, the long-term correction back down to reality. That's the reversal. And here's the really brilliant part. This one single psychological model explains both of the market's biggest patterns, even though they seem to completely contradict each other. The same theory that tells you why a stock goes up in the short term, momentum, also tells you why it eventually comes down in the long term, reversal. It's all connected. Now, this theory does more than just solve old puzzles. It gives us a really powerful new lens to understand all sorts of things that happen in the market, and even why corporations act the way they do. What makes this theory so great is that it makes specific, testable predictions. For instance, it predicts that these psychological effects should be strongest for stocks that are really hard to value. Like tech stocks or growth companies where there's a ton of uncertainty. And guess what? When you look at the data, that's exactly what you find. It even solves this huge puzzle in corporate finance. Why do companies so often issue new stock right after their prices soared? It's not because the managers are being foolish. No, they're being perfectly rational. They know their stock is probably overvalued because of all this investor overconfidence, and they're cashing in while they can. So ultimately, what we have is a single framework grounded in real human psychology that just unlocks the market's biggest puzzles. It shows us how these patterns that once seemed totally unrelated are actually just two sides of the same coin, driven by the very same human biases. It teaches us that the market isn't just a cold machine crunching numbers. It's a complex, living reflection of a fundamentally human process, making judgments when you're faced with uncertainty. So the next time you see a stock surge or fall, ask yourself, what's the psychology? What's the human story behind that price?